Well, hello members, this is LA, and what I want to do is share with you what we have been working on the last, I don't know, 2 or 3 weeks now, as we continue to develop this idea of the morning ranges and the targets in terms of upside, downside, if it's a trend day. And essentially what I want to do is I want to show you what we've been doing and show you how we're doing it and what it is that we're after with what it is that we're doing. So let's try to start and point out some things to start with. First of all, there's this big range to start with. That big range is where we expect stocks, commodities, whatever it is that we're doing this on for the day to trade. What is the range that is expected for the day? And so that expected range trade is going to be, the high is going to be here, the low is going to be there, and it's based on the neoclassical reads. For example, this is based on a swing point high retest regen. As it comes back into it, we expect it to hold. Market's been bullish. First time back, more than 6 bars, should hold. On the flip side, where should it go on the top side? Well, then we start looking at things that give us an idea of where that should go. And so if we do that, we end up with this. And then we have the extensions to the downside and to the upside. Again, neoclassical. Here's a swing point high that was broken. You broke underneath it. You couldn't hold it. You came back up. You tested here. You couldn't get over it. That would be an extension back up into here. That's about as far as you could expect it to go today if it's a trend day. If it breaks above this, that's its target. If it breaks below this, this is the target. And so that's what this is about. Now, how does it fit in? Well, I want to show you something. I'm going to slide this over so you can see it. This is the normal distribution bell curve. And as I was getting ready to do this show, I just put this together so that I could show you. I was actually kind of amazed at exactly how this ended up. If you take the bell curve distribution, right, and the one standard deviation, and remember, on a bell curve, one standard deviation is about 68.2% of all things that should happen if that distribution is in effect. And I do believe these distributions on these day trades fall within that one standard deviation. Now, as you notice, when we did this chart, we were down towards the bottom. So we didn't take a standard deviation 1% above and below that number. We didn't take it above and below the close of last night. That's not the ideal. In neoclassical, you look for things that tell you where the market should trade, and then what we're trying to do is give you a range that covers one standard deviation, 68% of what should happen. That's the key. What should happen? This should trade in this range today. If it gets outside of it and extends, where's it going to extend to? Well, unbelievably, 2 standard deviations, which capture about 27.2% of whatever's left. And it just so happens today's was almost exactly lined up. It was kind of amazing when I got ready to do this. This is what we're trying to capture. And so what we're really doing is we're saying 95+% of everything should trade in between here. 95% of all trades on any given day should be within the ranges that we're giving you. 68.2% of those will trade inside this range that we're giving you, right? And if we extend, that's the 2 deviations to the other side. Hopefully this gives you a sense of what it is that we're doing in the mornings for you, what it tells you, and therefore how you can use it. That's the standard deviation overlay on the markups that we do on the morning on the NQs and on the S&P 500, ESs and NQs. Thanks.